The year is 2026, and something unusual is happening in the financial markets. Not loud, not dramatic, no flashing red headlines, no emergency meetings broadcast on television, just silence. The kind of silence that usually comes before things fall apart. While markets hover near record highs, the people who know them best are quietly stepping back. Not retail traders, not YouTube gurus, not social media hype accounts, the people who move markets for a living. For 12 consecutive quarters, Warren Buffett has sold more stocks than he's bought. That has never happened before in his entire career. The man who built his fortune by staying invested is now sitting on a mountain of cash, more money than most nations hold in their reserves. And he's not alone. Behind the scenes, institutional investors controlling tens of trillions of dollars are preparing for something they don't like to talk about publicly. A significant market decline. Not a pullback. Not a healthy correction. A real drawdown. Some expect 10%. Others are bracing for 20%. And a growing minority believe that what's coming could be far worse. These are not emotional decisions. They're not driven by fear or headlines. They're driven by patterns. Patterns that have appeared before every major market collapse of the last century. What makes this moment unsettling isn't one single indicator. It's not inflation. It's not interest rates. It's not geopolitics. It's the alignment. Debt is rising faster than the real economy. Market gains are concentrated in a tiny group of stocks. Valuations have drifted into territory that historically precedes painful corrections. And investor psychology is drifting toward a familiar place. The belief that this time is different. We've seen this movie before. In the late 1920s, markets soared while warnings were ignored. In 1987, confidence collapsed in a matter of days. In 2000, speculation dressed itself up as innovation. In 2008, leverage quietly hollowed out the system from the inside. Different decades, different technologies, same underlying mechanics. Markets don't crash because of one bad event. They crash because they become fragile. And fragile systems don't need a big shock to fail. They just need a spark. Right now, that spark could come from almost anywhere. What matters isn't what triggers the fall. It's whether the market can absorb the impact when it does. And that's the question investors are starting to ask in early 2026. Not out loud, not on television, but quietly behind closed doors. In this video, we're going to break down why risk is building beneath the surface, how today's market mirrors the final stages of past collapses, and why the most dangerous phase of a market cycle is the one where everything still looks fine. Because history doesn't repeat itself exactly, but it does rhyme. And right now, the rhyme is getting louder. Market warnings are nothing new. Every year, someone predicts a crash. Every cycle there are voices calling the top. Most of the time they're early. And being early in markets often looks the same as being wrong. So the obvious question is this. Why should anyone take these warnings seriously now? Why isn't this just another round of pessimism while markets keep climbing? The answer is subtle and uncomfortable. Because this isn't about one indicator flashing red. It's about many indicators lining up at the same time. In healthy markets, risks tend to rotate. Valuations might be high, but debt is manageable. Debt might be elevated, but growth is broad. Growth might be narrow, but sentiment is cautious. What makes markets resilient is balance. What makes them dangerous is alignment. Right now, the market isn't dealing with a single excess. It's dealing with several, all reinforcing each other. Debt has expanded faster than productive economic output. Corporate borrowing has surged, not to build factories or hire workers but to buy back shares. Government deficits have become structural rather than cyclical. At the same time, market leadership has narrowed dramatically. A small group of companies now drives a disproportionate share of total returns. If you're not in them, you're not participating. And if they stumble, there's nothing underneath to catch the fall. Valuations, meanwhile, have drifted far beyond long-term averages. Not slightly expensive. Historically extreme. And yet, investor behavior suggests comfort, not caution. Volatility is treated as opportunity. Risk is reframed as innovation. Leverage is normalized. This is the dangerous phase of the cycle. Not when fear dominates, but when risk becomes invisible. History shows that markets are most vulnerable not at moments of panic, but at moments of confidence. Right before the Great Depression, economists spoke openly about a new era of permanent prosperity. Before the dot-com crash, profits were dismissed as outdated metrics. Before 2008, housing prices were assumed to be immune to national declines. In every case, the logic sounded convincing at the time. And that's the point. Market peaks don't feel like peaks. They feel like validation. They feel like intelligence winning. Like technology changing the rules. Like caution being left behind by progress. What we're seeing now isn't chaos. It's order, stretched too far. A system that works beautifully, until it doesn't. And the most unsettling part? The people with the most to lose seem to understand this. They're not predicting collapse on television. They're not ringing alarm bells on social media. They're quietly reducing exposure, raising cash, lowering risk, not because they know what will happen next, but because they know how fragile systems behave before they break. In the next section, we'll look closely at those signals. Not opinions, not narratives, but behavior. Because when smart money starts moving in the same direction at the same time, it's usually worth asking why. If you want to understand where markets are going, don't listen to what people say. Watch what they do. Because narratives are cheap. Positioning is expensive. Right now, positioning is telling a very different story than the headlines. While financial media debates whether markets can go even higher, some of the largest pools of capital in the world are quietly moving to the sidelines. For 12 straight quarters, one of the most patient investors in history has been a net seller of stocks. Not rotating. Not rebalancing. Selling. At the same time, cash levels inside major investment firms have climbed to historic highs. This isn't market timing. It's risk management. Large institutions don't need to predict crashes to protect themselves. They just need to recognize when the reward for taking risk no longer justifies the downside. And that's exactly what seems to be happening. Surveys of institutional investors managing tens of trillions of dollars reveal a striking consensus. A majority expect markets to fall. Not someday. Not eventually. Sooner rather than later. Nearly half are preparing for declines in the range of 10 to 20%. Some are bracing for more. These are pension managers, endowment stewards, sovereign wealth funds. Their mandate isn't excitement. It's survival. They don't chase momentum at the top. They don't need to be fully invested when risk is asymmetric. When they reduce exposure, it's usually because something fundamental has shifted. And what's shifted isn't optimism, it's pricing. Stocks are no longer offering a meaningful premium over safer assets. Investors are accepting volatility without adequate compensation. They're taking equity risk for bond-like returns. That's not investing. That's complacency. Meanwhile, liquidity, the invisible oxygen of markets, has become more fragile. When prices rise smoothly, liquidity feels abundant. When prices fall, it disappears instantly. Institutions understand this better than anyone. They've seen how quickly markets can gap lower when everyone tries to exit at once. They know that when leverage is high and ownership is crowded, there is no orderly way out. So instead of making noise, they're doing something far more telling. They're stepping back. Not because they know the exact trigger. Not because they believe collapse is guaranteed. But because history has taught them a simple lesson. When markets stop paying you for risk, risk tends to collect its payment anyway. In the next part, we'll zoom out and look at the bigger picture. The historical pattern that keeps repeating regardless of era, technology, or narrative. Because once you see that pattern, it becomes much harder to ignore what's happening now. Every generation believes its crisis will be different. Different technology, different institutions, different rules. And in some ways that's true. But underneath the surface, markets still run on the same forces they always have. Credit, incentives, and human psychology. When historians look back at major financial collapses, they don't see chaos. They see structure. A sequence. In 1929, stocks surged as credit expanded and speculation spread. In 1987, leverage built quietly inside an increasingly automated market. In 2000, capital flooded into a narrow group of can't-miss technology names. In 2008, cheap money and complex financial products masked systemic fragility. Different decades. Same architecture. Each collapse followed a remarkably similar progression, not overnight but over years. First came debt. Not productive debt but speculative leverage. Borrowed money chasing rising asset prices. Then came concentration. A small group of stocks began to dominate returns, pulling indices higher while the rest of the market lagged behind. After that came extreme valuations. Traditional metrics were dismissed as outdated. New narratives replaced old discipline. Then sentiment shifted. Caution became unfashionable. Skepticism was framed as ignorance. Risk was rebranded as opportunity. And finally, always, came the trigger. Not the cause. The catalyst. A relatively small event that exposed how fragile the system had become. This is the part most people misunderstand. Crashes don't start because something goes wrong. Something always goes wrong. They start because the market can no longer absorb shock. By the time the trigger arrives, the outcome is largely predetermined. What's unsettling about the current environment is how closely it mirrors the late stages of this sequence. Debt levels are elevated across households, corporations, and governments. Market leadership has narrowed to a handful of names. Valuations sit far above historical norms. And sentiment has shifted toward confidence bordering on certainty. These aren't isolated issues. They reinforce each other. Leverage amplifies gains, which attracts more capital. Concentration boosts indices, masking underlying weakness. Rising prices justify higher valuations, feeding optimism. Optimism suppresses risk perception, encouraging even more leverage. It's a self-reinforcing loop. And history suggests that once a market reaches this phase, it doesn't unwind gently. It waits, sometimes for months, sometimes for years, until something small breaks and reveals how much was already broken underneath. In the next section, we'll start breaking this sequence down in detail, beginning with the foundation of every major collapse. Debt. Because this is where the trap gets set, long before anyone realizes they're standing in it. Every major market collapse begins the same way, quietly. Long before prices fall. Long before panic appears. Long before anyone talks about a crash. It begins with debt. Debt by itself isn't dangerous. In healthy economies, borrowing funds growth, innovation, and productivity. But when credit grows faster than the real economy, something changes. Debt stops building value and starts inflating prices. Borrowed money floods into financial assets, pushing prices higher. Higher prices justify more borrowing. More borrowing pushes prices even higher. It feels like prosperity, but it's leverage disguised as growth. Over the past several years, corporate debt has surged to record levels. Trillions were borrowed, not to expand capacity or improve efficiency, but to buy back shares. This matters. Stock buybacks mechanically raise earnings per share and support valuations, but they don't strengthen the underlying business. They create the appearance of growth without the substance. At the same time, government debt has climbed beyond historical extremes. Deficits are no longer a temporary response to crises. They've become a permanent feature of the system. This creates a fragile foundation. High debt limits flexibility. It reduces the system's ability to absorb shocks. It turns small disruptions into big problems. Then comes the second stage, concentration. Markets don't collapse just because valuations are high. They collapse when too much value is packed into too few names. In healthy markets, gains are broad. Many sectors participate. Weakness in one area is offset by strength in another. But late in the cycle, leadership narrows. A handful of stocks begin to carry the entire index. Their success becomes synonymous with the market itself. Right now, a small group of companies accounts for a disproportionate share of total returns. If you're not in them, you're falling behind, even as headlines celebrate record highs. This creates a dangerous illusion. It looks like strength, but it's dependency. When markets rely on a few names for momentum, they lose resilience. One stumble doesn't stay isolated. Cascades. And because so much capital is crowded into the same trades, there's no easy exit. Debt and concentration feed each other. Leverage amplifies the winners. Rising prices attract more capital. The index climbs, even as its foundation weakens. This is how markets become fragile while appearing strong. In the next part, we'll look at the third stage. The moment when the numbers themselves stop making sense. When valuation ceases to be a debate and becomes a warning. Valuation metrics exist for one reason. Not to predict exact tops. Not to time the market. But to measure how much optimism is already priced in. They're imperfect tools. But when multiple metrics reach extreme levels at the same time, they stop being noise. They become signals. Right now, many of those signals are stretched further than at almost any point in modern financial history. The cyclically adjusted price-to-earnings ratio, designed to smooth out economic cycles, sits near levels seen only once before, during the peak of the dot-com bubble. At that time, investors argued that technology had rewritten the rules, that profits would come later, that traditional valuation frameworks were obsolete. They weren't. The market eventually repriced, brutally. Another long-term measure compares the total value of equities to the size of the underlying economy. When that ratio rises too far above trend, history shows future returns tend to disappoint. Today that gap isn't just wide. It's extreme. The market has grown far larger than the economic engine meant to support it. But here's what makes the current environment especially dangerous. The equity risk premium, the extra return investors expect for owning volatile stocks instead of safer assets, has nearly vanished. In simple terms, investors are no longer being paid to take risk. They're accepting uncertainty, drawdowns, and volatility. For returns barely above what can be earned with far less exposure. This flips the logic of investing on its head. When stocks offer clear compensation for risk, volatility is tolerable. When they don't, risk becomes a liability. And yet capital keeps flowing in. Why? Because rising prices create their own justification. Because recent performance feels like evidence. Because narratives fill the gap where discipline fades. This is the phase where markets drift into abstraction. Prices no longer reflect cash flows or productivity. They reflect expectations, layered on top of expectations, built on confidence. And confidence is fragile. When valuations are stretched, there's no margin of safety. No cushion for disappointment. No buffer for error. Earnings don't need to collapse. Growth doesn't need to reverse. All that's required is for reality to fall slightly short of perfection. In the next section, we'll step away from the spreadsheets and look at the most powerful force in markets. The one that turns overvaluation into instability. Psychology. Because bubbles don't burst when numbers peak. They burst when belief does. Markets don't collapse because investors are stupid. They collapse because investors are human. And human psychology doesn't evolve nearly as fast as technology or finance. Every major bubble reaches a moment where logic quietly steps aside. And belief takes over. This is the stage where skepticism sounds outdated. Where caution feels like weakness. Where risk is reframed as vision. You can hear it in the language. This time is different. The old rules no longer apply. You just don't understand the new paradigm. In previous cycles it was railroads, then radio, then the internet, then housing and financial engineering. Today it's artificial intelligence. And to be clear, transformational technologies do change the world. They create real productivity gains. They generate enormous value over time. But that's never been the problem. The problem is timing and price. When optimism about the future becomes embedded into valuations that assume flawless execution and unlimited growth, the margin for error disappears. At this stage of the cycle, markets stop rewarding prudence. Those who reduce risk feel foolish. Those who stay fully invested feel validated. Those who use leverage feel brilliant, for a while. Dissenting voices are dismissed as pessimists who missed the move. Bearish arguments are mocked rather than debated. This isn't confidence. It's consensus. And consensus is dangerous. Because when everyone believes the same thing, markets lose flexibility. They become one-sided. Any negative surprise, even a small one, has an outsized impact. What's striking about the current environment is how little fear remains. Volatility spikes are bought aggressively. Drawdowns are framed as opportunities. Liquidity is assumed to be infinite. Investors have been conditioned to expect rescue. For more than a decade, central banks stepped in whenever markets stumbled. That created a powerful belief. That downside is temporary and upside is inevitable. But belief isn't policy. And confidence doesn't prevent losses. It concentrates them. This is the phase where risk feels invisible. Where portfolios look strongest right before they become most vulnerable. In the next part, we'll move to the final stage of the cycle. The one everyone obsesses over but misunderstands. The trigger. Not what it is, but why it almost doesn't matter. This is the part everyone waits for. The event. The headline. The moment the crash begins. But history shows something uncomfortable. By the time the trigger appears, the damage is already done. The trigger doesn't cause the collapse. It reveals it. In 1929, there wasn't one single event. There was a sequence. Margin calls, forced selling, collapsing confidence. In 2008, it wasn't just one bank failing. It was years of leverage and hidden risk suddenly exposed. The spark gets remembered. The gasoline gets forgotten. Right now, the list of possible triggers is long. A geopolitical escalation that disrupts trade or energy markets. A banking failure tied to commercial real estate or derivatives exposure. A policy mistake that tightens financial conditions faster than expected. A sudden reassessment of growth assumptions in the technology sector. Any one of these could be survivable in a resilient system. That's the point. The danger isn't the shock itself. It's the system's ability to absorb it. When leverage is high, liquidity is thin, and ownership is crowded, Markets don't adjust smoothly. They gap. Selling begets selling. Losses force liquidation. Liquidation removes liquidity. What starts as a pullback becomes a cascade. And here's what makes this phase especially deceptive. The initial decline often doesn't feel catastrophic. In past cycles, early drops were dismissed as healthy corrections. Buying opportunities. Noise. It's only later, when selling accelerates and confidence breaks, that panic sets in. By then, exits are crowded. Prices move faster than psychology can keep up. Algorithms don't hesitate. Margin calls don't negotiate. Liquidity doesn't wait. This is why crashes feel sudden in hindsight. Not because they were unpredictable, but because they unfolded faster than most people could react. Right now, markets are priced for stability. For growth continuing without interruption. For policy remaining supportive. For narratives holding together. That leaves very little room for disappointment. In the final part, we'll step back from the mechanics and ask the most important question of all. What does this environment mean for you? Not for hedge funds. Not for institutions. Not for history books. For the person deciding how much risk to carry. When the margin for error is gone. So where does this leave you? Not as a trader. Not as an economist. Not as someone trying to predict the exact date of the next collapse. But as an investor living inside this moment. Here's the uncomfortable truth. Being in the market right now is a bet. Maybe you believe the current technological wave justifies today's prices. Maybe you trust that policymakers will step in before things get ugly. Maybe you're simply hoping to ride the trend a little longer and exit before everyone else does. That hope is common. And history shows it's usually misplaced. Markets don't ring a bell at the top. They don't send invitations before they turn. They don't collapse when fear is obvious. They collapse when confidence is widespread. Everything we've discussed. Elevated debt, narrow leadership, extreme valuations, disappearing risk premiums, institutional caution. These are not predictions. They are probabilities. Signals. Warnings that the margin for error has evaporated. If you're young, with decades ahead of you, volatility is survivable. Time is your ally. But if you're leveraged even modestly, or dependent on near-term liquidity, or assuming that markets will always bounce back quickly, this is the phase where mistakes become permanent. Crashes don't destroy everyone equally. They destroy those who borrowed against optimism. Those who assumed liquidity would always be there. Those who believed they'd have time to react. In 1929, most investors thought they'd sell before things got really bad. In 2000, they believed profits would eventually justify prices. In 2008, they trusted the system was too interconnected to fail. They weren't irrational. They were early cycle rational, in a late cycle world. Right now, in early 2026, we're standing in a familiar place. Not at the moment of collapse, but at the moment where warning signs are clearest and easiest to ignore. History is rarely kind to those who dismiss risk when it's quiet. When the history books are written about this period, the signals will look obvious. They always do. The only real question is whether you noticed them before the dominoes fell, or only after. If you value this kind of long-form historical perspective on markets, not hype, not predictions, but patterns, consider subscribing to Finance Archives. Here we don't chase headlines. We study what came before, so we can better understand what might come next. Because markets change. Human behavior doesn't. And that's where the real story always is.